If you have little to nothing saved for retirement, in this video, I'm going to go over what you need to do right now, step by step, to put a plan in action and then actually take the steps to become wealthy and actually create a retirement that allows you to live your life without worrying about money. The very first thing you want to do is start with the end. You got to know how much money you're going to need to actually be able to retire and live your life financially free. Now, this is where most people just randomly throw out a number. It'd be nice to have $500,000. Or $1 million, or $10 million without any sort of justification. So what I want you to do now is actually create a real number that will allow you to live your life financially free. The way you do that is by looking at how much money you actually need today. Look at your monthly expenses and see how much money you need to cover your basic expenses. If you say that you need $5,000 a month to cover your monthly expenses, you multiply that by 12 months a year, which means you're going to need $60,000 a year for you to live your life financially free. Now, this is where I want you to do two things. First, I want you to take the $60,000 and divide it by 7%, or divide this number by 0.07. And then I also want you to divide this number by 4%, or 0.04. I'm going to explain why in just a minute. So if you do that with $60,000, what you'll see is that if you divide it by 7%, that's going to show you $857,000. And if you divide it by 4%, that's going to tell you $1.5 million. What this just did is it gave us a range of how much money you're going to need in order to be able to retire and be able to afford the life that you want. On this side, I used 4% because the general financial planning tool is to look at the 4% rule. The 4% rule says that if you have this much money and you can pull out 4% of your principal, well, then your money is going to be able to grow and you'll be able to pull out enough principal every year to be able to live your life, be able to combat inflation, and not have to worry about money. The alternative, 7% here, is if you can take a little bit more risks, potentially invest your money other places that provide you with cash flow, then you could potentially get enough returns at a 7% return to be able to live your life at this price. But at the very least, what we know is that you're going to need some sort of range, some sort of money amount between here and here in order to be able to live your life financially free. If you can accumulate this much money but get this return, well, now you have more cash to live your life. But at least you know a range of where you need to be. Now at this point, you might be thinking something along the lines of, what the heck, Jaspreet? How in the world am I going to accumulate $857,000 or $1.5 million? How in the world am I going to put this much cash aside to be able to retire? Well, the nice thing is you don't actually have to put aside this 860 grand or this $1.5 million to be able to retire. What you need to do is you need to create a plan to start putting some cash aside, because then what's going to happen is you're going to put your money into assets which grow. So you're putting your money aside to grow, and then the money that you put aside will grow to attract you more money. So you're putting money aside, this money is making you more money, and then the money that your money makes will also work to make you more money. So you don't actually have to save this $860 to $1.5 million. You're going to have to save a fraction of this, but the money that you put aside needs to be growing. That way you can actually hit this number. That way you can achieve that sort of financial freedom to be able to retire. The simplest way for you to do that is to create a financial system, something like my 75-15-10 plan, which says that for every dollar that you earn for here on out, 75 cents is the maximum that you can spend, 15 cents is the minimum you're going to be investing, and 10 cents is the minimum that you're going to be saving. Now, if you hear that and you say something like, but Jaspreet, I can barely get by as it is. How am I going to put aside 25% of my income to my savings and my investments? Well, think of it this way. If the government happened to pass a new tax tomorrow, and this new tax said that you have to pay an additional 25% of your income for whatever, what are you going to do? You're going to kick, scream, cry, complain, whatever, be upset, but then you're going to find a way to pay it. And just like that, you have to find a way to pay yourself first, because this is how you're going to become wealthy. You have to find a way to put some extra cash aside, whether that means you have to earn more money or you have to find places to cut your expenses. You have to find a way to pay yourself, because if you don't, you're never going to be able to create some sort of financial freedom or any sort of wealth. So you have to find a way to put some extra cash aside. And then if you follow the system, let's just put some numbers in it. So if you're making that $5,000 a month, like we talked about earlier, if you put aside 15% for your investments, that's $750 a month. Well, if you multiply that by 12 months in a year, that's $9,000 you're putting aside towards your investments a year. Now remember, you don't have to accumulate all that money that I showed you in the earlier whiteboard. What you have to do is you have to invest your money and grow it to that amount. Now, the easiest way to see what type of numbers you can get and what type of returns you need is to use a compound interest calculator. I linked one down for you in the description below. That way you can play around with it for yourself. But the way it would work is if you're going to put aside $9,000 a year, let's assume that you have 30 years to do this. Now what you can do is you can mess around with the interest rates that you can get. If you get a 5% annual return on your money, which is below average, well, then you're going to end up with about $625,000 in your investment account. If you can get a 7% return on your money, closer to average, well, then you're going to end up with around $900,000 in your investment account. And if you can get a 10% return on your money, well, then you're going to end up with $1.5 million in your investment account. So you can see that 7 to 10% is the typical stock market return historically. If you look at all the years in the last century and you average it together, this is the historical average return, which shows you how much money you would end up with if you consistently invested your money. Now you can see you don't have to actually put that much money aside. Your money will grow to the amount that you need to be able to live the life that you want. Now, if you've been watching my videos, you might be thinking, but Jaspreet, what about inflation? Isn't inflation going to eat away at my investment amounts? And you're right, inflation does make the value of your dollar drop, but you have to remember, you got to adjust this with inflation. Because if you see inflation, your wages should also hopefully go up as well. So if your wages go up as well, that means you're going to put your money through this funnel, which means you're going to be investing more dollars, which means you're going to have more money going into here, which will automatically adjust these numbers based on inflation, which is why you need a system like this, where the more money you make, the more money you're going to be investing. The next logical question here is, where do you actually put your money? Should you put it into a CD, your 401k, your IRA, the stock market, a real estate investment, a business? Where do you put this money to actually see this growth? Here are 5 of the most common ways to invest your money, and I labeled these in order of smallest return to biggest return, but they also come with smallest risk to highest risk. Now, one of the things that you can do to limit your risk and increase your returns is just to invest in your financial education, meaning learning how to invest, knowing what's going on in the markets. That way you can make better decisions with your money. I have tons of videos on my channel that go over that type of financial education. And if you do want to stay up to date on what's happening in the financial markets, that way you can make better decisions with your money, well, that's why I created something called Market Briefs. It's a completely free financial newsletter that covers what's going on in the stock market, the real estate market, the crypto market, inflation, and the global economy. It's completely free, and it's an easy way for you to stay up to date on what's happening. That way you can make better decisions with your money. So if you want to join Market Briefs for free, I'll put the link to how you can join down in the description below. Now, if we talk about your savings and CD, well, this is your traditional place to park your money. But the reality is you are not going to get big enough returns here or here to actually grow your money into something significant, because CDs and savings accounts pay next to nothing. So I'm just going to cross these out. Then when it comes to stocks and real estate, these are interchangeable. Some people will tell you the stocks get better return. Some people will tell you that real estate gets you a better return. This is really a matter of personal preference. I've invested my money into the stock market and the real estate market, and they both can do really well, and they both can lose you everything. It goes down to your financial education, your interest, and how involved you want to be. And the nice thing, I'll get into this in a little bit, is with both of these, you can start investing with as little as $100. Yes, you can get exposure to real estate with as little as $100. You're not going to be able to buy the entire property, but you can get exposure to real estate through real estate funds. So this is going to be interchangeable as to which one's going to give you more risk or give you better returns, but that I'll leave up to you and what your interests are. Then you have business. Now, for, again, the majority of people, this is not going to be something that's interesting or applicable, because starting and owning your own business is difficult, very time consuming, and not everybody wants to operate a business or should operate a business. And even if you don't want to start a business, you can buy a business. But again, that's very time intensive, and it's not for the majority of people. So I'm not going to talk about this in this video. I'm going to focus in on here. I'm not going to talk about the alternative investments, things like cryptocurrency or gold or the other alternative investments. I have other videos talking about that, so you can research that on my channel. I'm going to focus in on these two things, stocks and real estate, as a way for you to invest your money and build wealth. Now, to invest in stocks and real estate, there's a number of different ways that you can do that. The first way to invest your money would be to using a tax-deferred retirement account, something like an IRA or a 401k. This also includes the 403bs and everything else. They all work very similarly. The whole idea here is you invest your money into an account that gives you tax advantages, because now you can't pull your money out of this account until you hit retirement age. If you try to pull your money out earlier, you're going to have to pay a penalty. And then when you hit retirement age, you can pull the money out, and that's when you're going to pay taxes. Unless you use a Roth version where you pay the taxes up front, then your money can grow tax-free, and then you pull the money out tax-free. Now, you have some subtle differences between your 401k and your IRA, but the main difference you have to understand is that the 401k is a retirement account that you get from your employer. The IRA is a retirement account that you get outside of your job. This is something that you have to go out and create yourself. So this is what it looks like. You have this income stream right here. Let's call it your job. Your job pays you. And now if you put your money into a traditional 401k or IRA, you are going to bypass paying taxes, and you're going to put this money into an investment account right here. This is your 401k. This could be your IRA. And now if it's a traditional 401k or IRA, you don't have to pay any taxes when the money goes in. Now this money can grow, be invested, and compound tax-free. And then you hit retirement age, and that's when you're going to pull the money out, and that's when you're going to pay taxes. Now you can compare this to something like a Roth 401k or a Roth IRA. This works a little bit different. Right now you have your income source right here. I'll call it your job again. You make money, and then you're going to pay taxes. TAXES. Oh my God, my letters are not working. So now you're going to pay taxes, and then your after-tax dollars are going to go into this investment vehicle. So now you have less dollars going in because you paid taxes on it first, and now this money is going to be invested. It's going to grow and compound, and then when you hit retirement age, that's when you're going to be able to pull the money out, but now you've already paid taxes on it, so you don't have to pay taxes on the back end. Now there are some subtle differences where sometimes you do have to pay taxes here depending on how this money was earned and what's happening there, and this money can then be invested in the stock market or the real estate market. There are ways that allow you to invest your money into real estate with a 401k and an IRA. In an IRA, you need a self-directed IRA. Same thing with the 401k. There are solo 401ks that allow you to invest your money in real estate. But now you invest your money in these vehicles, and now you're going to be able to go out and get this growth tax-free. The 401k and IRA both have limits to how much money you can put into your investment account every year, and when you're trying to decide what's better for you, this is where you have to ask a couple questions. Some people say that this is better, to do the traditional IRA, because the whole idea is when you hit retirement age, you're not going to have an income, so your tax rate is going to be lower, so you're not going to have to worry about the taxes because you're just not making as much money, so you'll effectively have a lower tax rate. The argument here for the Roth IRA is, well, no one knows what the tax rate is going to be when it comes time for you to retire. And if the tax rate is a lot higher, you could be paying a penalty by waiting to pay taxes. And so you have that advantage of paying taxes when the money goes in. And now your money can grow, and you can see more potential upside if your money grows a whole lot. And now you don't have to worry about the income. Me personally, if you want my opinion, I don't like the idea of taking this risk and waiting to see what the tax rate is going to be on one end. And on the second end, I don't like the idea of not planning to have any income when I'm older. I am working my income and my businesses to have a lot of income when it comes time for me to hit my 60s or my 70s. So for me, that would make no sense because I'm working to grow my income every single year. So I would not follow that whole persona or idea that I'm not going to have any income when I'm in my 60s. Second, the national debt keeps growing, and on a more economic level, if the government's debt and expenses keep growing, that typically would mean higher taxes. So if I had to guess, again, this is just my prediction, I would say the taxes are going to be higher in the future than they are now, just because of the way that our economy is changing. Now, second, on the whole idea of an IRA and 401k, I'm personally not a huge fan of the traditional idea of retirement. The traditional idea of retirement meaning I work until I'm 65 or 70 years old, and then once I hit that age, I stop working because now I have enough money or wealth built up. I don't like that idea. I want to work until I die because I love what I do. Now, I get it, not everybody can do that, but I really believe that whole idea of those who retire early, die early, because when you follow that old pattern of just working and then not working, I've seen this happen to people in my family where you hit retirement age and then you just sit on your sofa, watch TV all day long, and you do nothing productive. And that's when you start to see all those health issues pop up immediately because now you have no purpose, you have nowhere to go, you're not doing anything. So I don't like that idea of retirement. And for me, I'm not a huge fan of these traditional retirement accounts because of all the restrictions that they put on you and all of that. And this is where just basic education of your 401k and IRA are so important, because many people don't understand how their 401k or IRA work, and they just throw their money in there without understanding the fees. And the thing is, when you put your money into your 401k or IRA, you're essentially, for most of the time, giving your money over to a money manager. And if you don't know how much they're charging you, well, chances are they're probably overcharging you. And this is why I like to be in charge of my investments, because I like investing my money. I like doing that research. This is something that I'm interested in. It's something that I do a lot of. So for me, an IRA or 401k doesn't make sense. I don't have either one of these. I invest my money myself because it gives me more control, it gives me more freedom, and I want to be able to control and access my money however I want. And if you invest your money yourself into businesses and real estate, you can actually get bigger and better tax breaks than you get here. So for me, this is not interesting. But for the majority of people, if you don't like the idea of going out and investing in real estate, if you don't like the idea of managing all of your investments, this is a great way to start. But you don't want this to be your only investment. You also want to be investing outside of your 401k and IRA. That way you can build your financial education and grow your wealth and achieve your financial goals. The next way that you can invest and grow your money is in the stock market, and there's a couple different avenues that you can grow. One is by passively investing your money, one's by actively investing your money. And when I say actively investing, I don't mean trading your money when you're trying to flip a stock for a quick profit in less than a year. I'm talking about buying an undervalued company and holding on to it for the long term. But in this case, you're actually investing in individual companies. Passive investing is where now you create a strategy, a system where anytime you get paid, now money is automatically pulled out of your checking account and is invested into a portfolio of ETFs or index funds. If you don't know what an ETF or index fund is, then you can watch some of the other videos on my channel. But your money is automatically invested into these funds, and it's completely passive and it's consistent, and this continues to go on whether the market is up or down. I like this because this is completely passive. And this is a way to keep getting exposure to the markets without even having to think about it. For the vast majority of people, this is the best way for them to invest their money, because if you're not willing to do that research and put in the time and the effort to actively invest, well, then it's just gambling. That's where this is a proven way for you to actually grow your money and become wealthy, as long as you don't touch your investment. You just keep investing when things are up and when things are down. And if you want to change anything when things are down, that's just an opportunity for you to come in and buy even more. Now, there's a number of platforms that specialize in this type of passive investing. You could check out them on Google. I use a platform called M1 Finance. I like it because it's super simple to use. It's free for you to invest your money, and they allow you to do this type of passive investing. Now, if you want to learn more, they are an affiliate of Minority Mindset. So if you want to check them out, I got their link down in the description. If you use my link, we will get compensated. But there's a ton of different apps out there. So find the one that you like the best. I just like M1 Finance because it's super simple to use and it's very clean, and they focus here on the passive investing side. Active investing, like I said just a minute ago, is where now you're actually doing the research. You're researching companies. You're reading their financials, you're keeping up with their executives, you're looking at their products, and you're seeing what the company is doing. And based off of that, you're going to look for a good buy point, a good entry point where you believe the company is undervalued. And that's when you want to come in and buy, and then you want to hold on to the company for the long term. Now, this is interesting for some people, but other people will hate it. Actually, most people will hate it. It takes that financial education, and it also takes the psychology education to know how to manage your investments, to know how to not sell when things are bad, and know how to not get greedy when things are going upwards. So you have to understand the psychology and the financial education. But for the majority of people, this is not something you want to be doing, because when the majority of people try to do this, they end up trading and they end up losing all of their money. That's why this is the better option for the majority of people. If you are willing to invest in your financial education, and if you're willing to put in that time, and if you're willing to invest in your psychological education, then this can be a great way for you to increase your returns, but it's going to take more effort on your part. Then we have real estate investing, which is one of my favorite ways to invest your money. And again, there's a couple different ways that you can get exposure to real estate. You can get exposure to real estate through real estate funds, and then you can get exposure to real estate through actually owning the property. Funds are now ways for you to invest little amounts of money and not have to worry about the headache, but get exposure to actual properties or a portfolio of real estate properties. Now, because of technology, some of these funds let you invest in real estate with as little as $1,000, some of them as little as $100. I invested some of my own money into Fundrise a number of years ago, and that investment worked out pretty well. But the whole idea here is you don't have to worry about the headache. Like, you don't got to worry about finding tenants or leasing the property or managing the property or dealing with accountants and property managers and contractors and all of that. You're giving your money to a fund which gives you exposure to the deal, and then you're going to let the expert investor and developer manage the deal, so you don't really have to worry about any of that headache, and you can put in lesser amounts of money. Now, if you do want to learn more about this, Fundrise is also an affiliate of Minority Mindset. Again, you can find whatever companies you want. There's a bunch of them out there. I liked Fundrise. Of course, it has risks because you're getting exposure to real estate, but if you want to learn more about them and see how you can invest with them, I got their affiliate link down in the description. If you use them, you will get compensated, but again, do your own research. Second is investing in the actual property. I prefer this over this because I like the control side, but this takes a lot more work. Because if you want to invest in the actual property, that means you're going to need more capital and you're going to need a team. Because now I'm going to go out and buy actual properties, and I have a management company. I have the whole team to manage the property, do the renovations. I have my accountants, my attorneys, I have my leasing agents. So it takes a lot of work to get started, but once you do it, it becomes a lot easier. And this is where you got to understand if this is something you would like or not. The reason why I like real estate investing is because now you're going to buy this physical property, a house, an apartment complex, whatever it might be. And if you do it correctly, it is going to pay you cash every single month. And this cash, if you do it correctly, will cover all of your expenses and put some money in your pocket each and every month. And the best part is that real estate provides some of the biggest and best tax breaks that our tax code has to offer. I can tell you this because I am an attorney, although I'm not your attorney, but real estate has a lot of potential here in terms of wealth, which is why wealthy people love putting their money in real estate because, well, you get cash flow and you get tax breaks. Meaning there are ways for you to generate profits, put money in your pocket, but pay no taxes on that money because real estate provides those types of tax breaks. But again, it takes more cash to get started, and it takes more effort to get started. But if that's something you're interested in, it's something you should be working towards, learning about, and seeing how you can actually invest in the entire property. If you want to be a successful real estate investor, there are 5 areas that you have to master, that you have to understand if you want to be able to make real money in real estate. This is, you have to understand how to find the right location. You heard people say location, location, location. Well, it's 100% true when it comes to finding good real estate deals. Second, you have to understand how to find a good property, because if you have a good location and you have a really crappy property, well, you can still lose a lot of money. So you want to know how to find a good property, and how do you know what's a good property or not? Third, you have to be able to understand the numbers. You need to be able to know how to run the numbers, how to find a good cash flowing property that's going to actually make you money and not be a money pit. Fourth, you have to understand the tax side, know how you can use the tax code to your advantage in this particular deal that you're doing. And fifth, you need to understand and master the management side, because if you don't know how to manage your deal, well, it's going to be a major headache. These are the 5 things that I'm going to be talking about in this video. So let me start by talking about number 1, understanding the location. When you're investing in real estate, you are making a long-term investment. So you're investing for the next decade or 2 or 3 decades. You're not just investing for the next 6 months or the next 12 months. So when you're investing in real estate, you have to make sure that you pick a good location, because you can change everything about a property. You can change the way it looks, you can upgrade the bathroom, you can finish the basement, but the one thing that you cannot change is the location of your property. So you want to make sure that you're investing where people want to be in the future, not just where they want to be today. Because if you invest your money into a dying city where people are moving out of, where nobody wants to be, well, not only are your property values going to drop, but you're going to have a very tough time renting this property out, keeping it rented, and making any money on this property. And that's going to be a big pain, not just in your brain, but also in your bank account. So this is where you have to know, how do you find a good location for a property? And there's a few different things that you can do. The first thing that you can do is just go onto Google and enter in the city or the neighborhood that you want to invest in, and just type in the word population. population. And what you'll see is you'll get a chart of what the population is and has been for this particular neighborhood or this particular city. And you want to see some sort of upward trend, or at the very least, a stable trend for this city or neighborhood. Because if you're seeing populations go down, that's probably not a place where you want to be investing your money for the long term. The second thing that you can do to dissect the location is just go to the city hall of the area that you want to invest and ask the building department what new developments are in the works or potentially could be coming in the future. This is a little known secret of a way that you can get real insider information of what's happening before it even becomes public. And this is actually legal in real estate, but it's illegal in the stock market, because if you learn something in the stock market before it hits the public markets, well, now you're doing insider trading and you can go to jail. In real estate, well, it's completely legal. And this is where now you can get a lot of value by just talking to the city, talking to the people that work there, talking to the people that live there to see what's happening or what might be coming in the future before it even hits the mainstream news. This is something that I have done on multiple occasions. I found out, I was looking at an apartment complex in a city, and I went to the city hall and I asked them about this vacant building that was sitting on this very busy intersection, and I asked them if anybody had plans of purchasing this building or anything going on with this building. And what he told me was that Walmart was in contract to actually open up a franchise or a store over here in that building. Now, this wasn't public information, or at least I hadn't heard about it until I went to the city hall. But this was great news for me, because now I knew Walmart was going to bring a lot of money into this particular area. Because if Walmart comes here, then you're going to see a bunch of other smaller retail stores also pop up, because now Walmart's going to bring a whole bunch of traffic to this particular area. People are going to want to be here because you're going to see more shops open up. You'll see more restaurants open up, because this is going to drive up demand for this particular area. So what you want to see is, are businesses moving into this city? Are businesses moving into this neighborhood, or are they moving out? If they're moving out, then you might not want to be moving your money in. But if businesses are moving their money in, then this is something that you can consider moving your money into as well. You also really want to pay attention to barriers and boundaries, because what you'll see happen is many cities will have some sort of boundary or barrier that will divide a good part and a bad part of a city. Sometimes it'll be a highway, sometimes it'll be a bridge, maybe it's a lake, maybe it's something, a railroad track in the middle that divides a good part of a city from a bad part of a city. And this can make a huge difference, because you might see a city as a whole, and the city will be growing and people like the city. However, what you might not see from that data is that people are moving from this part of the city to this part of the city. And so if you find a property on this part of the city on sale, you might think it's a great deal because it's in a growing area and a place that everybody wants to be. But what you don't see from that data is that everybody wants to be on this side of the highway. I saw this happen on a property that I bought. It was a single family home where there was a highway running right through the city, and all the businesses were moving here. You literally had businesses moving from this side of the highway to this side of the highway, and everybody wanted to live on this side of the highway, and the properties on this side were selling for significantly cheaper on this side. Well, I bought a property here because I wanted to be on this side, even though it was more expensive than here, and over the years, it really paid off. The property values here went up significantly faster than the property values here, along with the rental prices and the ease of finding a good tenant, because everybody wanted to be on this side, not this side. This brings me to number 2, understanding the property. And one of the best sayings that I heard about this is, find the worst property in the best location. Because you can't change the location, but you can improve the property. So if you have a good location, it's worth paying a premium to be in a good location, even if the property isn't as good, because then you can upgrade the property, make the property better, but you can't change the location. You can't buy a property here and move it here unless it's a mobile home, but you can't move a property across state lines or across a highway line, but you can improve the property itself. Now, this is where you have to understand what kind of property it is that you want to invest in, because you can invest in single family homes, you can invest in duplexes, triplexes, quadplexes. You can invest in apartment complexes. You can invest in commercial buildings, office buildings. You can invest in retail plazas. You can invest in medical centers. There's a bunch of different types of real estate that you can do. And this is where you have to understand what's important for you and what do you like and what do you want to specialize in. I personally prefer residential. I like apartment complexes, I like single family homes. I did invest in one mixed use building which had some commercial and some residential, but I only did one of those deals. But I like residential because for me, that is the easiest thing for me to understand. because everybody is always going to need a roof over their head. So I can easily understand the demand side of a residential building versus something like an office. Well, that's a little bit more difficult because, as we can see around us, the office environment changes with the economy, and the demand for office is going to change with that. And so the requirements of an office are very different than the requirements of a residential property. And then same with retail. Retail always changes. I mean, the world is moving digital. Some stores thrive in brick and mortar businesses. Some stores don't do well in brick and mortar. So I don't really understand that space as well as I do the residential side. That's why I focus on the residential side. Now, you can find what you like and what you're familiar with and invest in that, but the whole idea here is you want to be investing your money into a property in a good location. Now, once you figure out what type of property you want to invest in, the next thing you have to decide is how turnkey you want this property to be. Some investment deals are going to be completely turnkey in that it's a property that's already rented out and you don't have to do anything except just buy the property, and now it's already producing cash flow. So there's nothing you got to do. The other side is you're going to find distressed properties where not only does this building or house or whatever not have a tenant, it's not even fully functional. Like, it's got ugly carpets, it needs to be renovated, it smells nasty, so you have to put in physical work. Now, you have to figure out where you want to be, but the advantage is if you buy this more distressed property, you're going to get a bigger discount than if you buy a fully turnkey property, because if you buy a property that's turnkey, you're paying a premium. Because now the person who owned it before, the investor, the developer, they put in the time and effort to make sure the property is beautiful, to make sure that it's all set up, to make sure that the tenants are already there and paying. And now what you're doing is you're paying for this completely passive deal where all you got to do is now get the cash flow, get somebody to pay the money into your bank account instead of theirs. So you're just buying a stream of cash here, which is much more passive than finding a deal that's much more distressed. So this distressed deal is going to come at a bigger discount. You can negotiate a better price, but it's going to come with more work, because not only are you going to have to renovate the property, but then you're going to have to get it filled up with good paying tenants, which takes time and it needs a good team. Most of the deals that I have done to date have been on the distressed side, where either it's an apartment complex or a home that has been completely run down. Maybe it's been into foreclosure, where now this property needs work. And now I can purchase this property at a discounted price, meaning below market value. Then I have a team now of contractors. It took me a long time to build a good team of contractors, but I have a good team of contractors that's reliable, that does good work, that does it at a decent price, and then they will come in, do the work, turn the property around, make it look significantly better, and now I can rent it out and make a bigger profit because I've been able to come in and buy the property at a lower price. But it takes more work. And it takes a time, because I had to go through really bad contractors. I had to go through a lot of headache with contractors, and I had to go through all that really effort, learning, and time in order to get to the team that I have today. But you have to decide, if that's something that you want to do, because not everybody's going to be wanting to work with these types of distressed deals, and not everybody has the cash to go out and pay a premium for the turnkey deals. Like when I was getting started in real estate, I had no way of affording these turnkey deals. The only things that I could do was buying the properties out of foreclosure. The one thing that I want to emphasize here when it comes to finding a good property is you don't necessarily want to go out and find the cutest and the best looking property. You want to find the property that's going to pay you the best return on your money, because you're buying this property as an investment, not as a place for you to live in yourself. Now, you want to provide a nice home for the tenants that are living there. You don't want to be a slumlord, because you're going to get burned in many different ways. But you don't want to buy this property with the intention of you living there. So you have to change that standard, but you have to understand that, hey, a good deal is something that's going to provide good cash flow, and then if you can improve the property in the best way possible, that way your tenants want to stay there, that way they want to pay you a premium, well, that's great. But you have to remember that you're buying this property to rent out, not to live there yourself, because now you got to look at number 3, the numbers. Every investment property that you buy is going to have these 5 expenses. You're going to have to pay for your property taxes, you're going to have to pay for your property insurance, you're going to have to pay for your property maintenance, you're going to have to pay for your property management, and then you're going to have to pay for vacancy costs if there are any. Now, this isn't money that's coming out of your property per se, but this is money that you're not making. So when you're factoring the numbers, when you're doing the deals, you have to make sure that you look at all of these costs to make sure that the property is still going to be profitable for you. So when it comes to taxes, I'll kind of work down this list. When it comes to taxes, what you have to remember here is that the seller's taxes that they're paying today is not necessarily going to be the taxes that you pay after you purchase the property. Because after you buy the property, the taxes are going to be reassessed. The property value is going to be reassessed. And if the seller purchase the property at a much cheaper price than what you're buying, well then chances are their taxes are going to go up because now the city can say, all right, this property is now 2x more than what the seller paid for it, so now we're going to increase your taxes. This doesn't necessarily mean that your taxes are going to double because the chances are that the city was increasing the taxes for the seller every year, but there's a limit to how much a city can increase taxes every year. However, once a property gets sold, there's no limit to how high property taxes can go. So before you buy a property, just talk to the city. Ask the assessor how much the property taxes are probably going to be, and they can give you a good rough estimate of what your property taxes will look like. Second, when it comes to insurance, this is something that you do not want to miss out on. You have to have insurance, and the insurance here is going to do two things. One is going to insure the property, and second is going to insure you. So you want to insure the property because in case something happens to the property, it gets burned down or something really bad happens to the property, that you have insurance to cover the cost of the building. The second side is your liability, because if your tenant slips and falls on the property and they decide to sue you, you want to make sure that you have insurance to protect you from this lawsuit. And the reality, especially if you're in America, is that anybody can sue anyone for anything. I can tell you this from personal experience because my real estate company was sued because one of my tenants sued my real estate company because they claimed that the bathtub was too slippery when the water was on, and this caused the tenant to slip in the bathtub. It was completely a frivolous lawsuit. The tenant worked with one of those free attorneys who was just trying to get a settlement from my insurance because they know that we have insurance. But the reality is, if I did not have insurance, well, then I would have to go out and hire an attorney and pay somebody out of my pocket to try to dispute this, and it would have been so much more expensive out of my pocket. But because I had insurance, it didn't really come out of my pocket. It came out of my insurance's money because I paid money into my insurance every single month. And so while my insurance company had to settle to make them go away, which is pretty crazy, it didn't come out of my pocket. So you want to make sure you have insurance because you never know who's going to sue you for what. That's just the reality of this country. Third, you have to factor in maintenance. Even if you think this property is up and running, is perfect, is brand new, always factor in some sort of maintenance fee every single month per unit. And even if you don't use this money, well, now your real profits are just going to be higher than your projected profits, which I'm okay with. So always factor in some sort of maintenance when you're running the numbers. So you might see, okay, this unit, this house is making $1,500 a month. And you might factor in $100 a month or $150 a month for maintenance. But if you don't use that, well, that's an extra $150 in your pocket. But if you don't factor in the maintenance when you're looking at the revenue minus your expenses, and you're already running this deal super tight, and then you find out that you have maintenance expenses, well, now you're in the red, you're running a negative, you're running a loss because you didn't factor in the maintenance to begin with. So always factor in some sort of maintenance cost. Fourth, factor in a management fee. I don't recommend that you manage a property yourself. I always recommend that you hire a professional property manager whose sole job is to manage the property. Make sure the property is leased out. Make sure the tenant pays, to document everything that's going on with the tenant, to fix the repairs, to get everything done with the property. But if you really insist on managing the property yourself, I would still recommend factoring in this management fee. That way you know what the cost is for the management. You're just paying this to yourself. But now, at least when you're factoring together the deal, you understand how much this would be, because now if you try to sell this as an investment unit, if you try to sell your property as an investment deal, the new investor is going to factor in a management fee, even if they don't want to manage it themselves. They're going to factor that into their pro forma, meaning their spreadsheet. And so if there's no management fee for when you buy it, you might be overpaying for something that you can't sell for the same price. So make sure you factor in a management fee when you're looking to buy a property. That way you know that it's going to be profitable for you. And the last one here is a vacancy cost, because the reality is sometimes tenants are going to leave. And when a tenant leaves, there's going to be time before the new tenant moves in. So you want to factor in a vacancy cost. And you can even apply a very simple 1 month a year vacancy cost. That way now, once you factor in all these expenses, you can see what the property would look like. Now, if nobody leaves, if you have very little maintenance, if your property taxes aren't as high, no big deal. You just have more money in your pocket. But at least you took that conservative financial statement and you knew what the expenses would be, and you factored in the other potential costs, because the last thing that you want is for you to anticipate making a profit, but then you're losing money every single year. And then you also want to factor in your mortgage. If you're gonna not purchase a property cash, if you're gonna have debt on the property, you want to also make sure you factor in the mortgage, and then you want to make sure that now after you factor in all these costs, that it's still profitable for you. My goal when I invest in real estate is to make a minimum 7% cash on cash return on my money, meaning if I go out and I invest, say, $100,000 of my own cash, I want to make sure that after paying all of these expenses, this property is putting $7,000 of profit into my pocket every single month from cash flow. Not from invisible appreciation of the property value, but from actual cash flow from the property. That's the type of return that I'm looking for. Yes, these types of returns are possible here in the Midwest, which is where I'm located, but it's going to vary area to area. But these are the types of returns that I'm looking for. So what you want to do is you need to know what type of return is good for you, and then make sure now that you factor in all of your expenses and then see if the deal works for the numbers. The fourth thing that you have to understand is taxes. And I'm not talking about the property taxes here. I'm talking about the taxes that you pay on your income. And this is where having a very good tax advisor, a real estate tax advisor, is going to be so crucial. Now, when you're investing your money in real estate, you want to make sure that you have a really good real estate attorney representing you, because there's going to be a whole bunch of little issues that can come up with real estate. So you want to make sure you have a good attorney. You want to make sure you have a good contractor that can take care of your deals, that can help you out with that. You want to make sure that you have a really good real estate agent that you can work with that will find you real estate investment deals. So these are agents that are not working to help people buy and sell their dream homes. You want an agent that's going to help you find an investment property, but you also want to make sure that you have a really good tax advisor, an accountant that's going to help you, who specializes in real estate, because real estate has a whole textbook full of special deductions, of special tax breaks that you can use as a real estate investor. And these can be things from special entities that you create, from ways that you purchase properties, from ways that you take depreciation, to ways that when you sell a property, how do you buy a new property? That way you can literally make money without paying any money in taxes today, because real estate has some of the biggest and best tax breaks that a tax code has to offer. Now, I am a licensed attorney, although I'm not your attorney, and I'm telling you this from experience because you need to have somebody professional who's guiding you. Now, one thing that I've learned is that there's a difference between a tax filer and a tax planner. Like, I've had a CPA in the past who would just file my taxes. They would look at my bank statement, my credit card statement, and all of that, and then they would file my taxes, but would give me almost no guidance as to what I can do to limit my tax liability. Now I have a tax advisor that cost me a lot more, but now I'm meeting with my tax advisor pretty often, and we're working to talk about how much is my tax liability and what are things that I can do based off of the current deductions, the current tax laws that are happening right now, because they change every year. What things can I do right now to limit my tax liability? And this will change the way that you do business. And so now when we talk about real estate, there's a lot of different things that you can do. So you want to have a tax advisor earlier on, because one of the things that they can do is they'll work with you when it comes to the actual purchase of the property, and you'll learn how much is the building worth, how much is the land worth, and then within the building, how much is the carpet worth? How much are the appliances worth? How much are the different things within the property worth? Because then they can depreciate the value of each one of these things differently on your taxes, and this will provide you different levels of tax breaks each year that you own the property. Because when you own real estate, one of the things that you can do is every year you will tell the IRS how much money you made in your profit. And then against that profit, you will also take another deduction called depreciation, which essentially says my real estate is 1 year older, so I deserve a tax break. Now, the amount of money that you can depreciate is going to depend on the value of the building and the value of everything else inside of the property. And so if you have a good tax advisor, you have a good accountant that can work with you to figure these things out earlier, you can start taking these tax breaks sooner. So when you start making money, you know that you're going to be paying the least amount of money in taxes as legally possible, because the IRS gives you a rule book. The rule book is the tax code. And this is where now, if the tax code says that you can take certain deductions and certain depreciations, you should take these things, but you need somebody who can help you do that. And fifth, you need to know how to manage the property. One of the people that you have to have on your team if you want to be a passive real estate investor is a really good property manager. And I'm saying that they have to be really good because I have worked with really bad property managers who didn't do much. Like the first investment deal that I bought, I had a horrible property manager who really didn't do anything. I found the tenant. The tenant had my cell phone number, and every day I was getting calls from my tenant about random things because this was a nightmare tenant. But I learned the value of having a good property manager. Now, not only is the property manager going to make your life easier because now they're the ones that are finding and dealing with the tenant to make sure everything is good, but the flip side of that is they're also supposed to document everything. So I talked about the lawsuit that I had to go through, where a tenant sued me because it slipped in the bathtub because it said that it was too slippery when the water was on. Well, we had done everything above and beyond for the tenant, because anytime the tenant filed any sort of complaint for the property, we sent contractors immediately to the property and not only solved any issue that they would have had, but tried to do even more. Like one time they did say that in the bathtub there was a little chip of paint. It was like a 1/4 inch by 1/4 inch, a little tiny chip of the paint. So they called up the property management company. My contractor went out there. Not only did he give an estimate to take care of the paint chip, but he also offered to put in a handicap pole for the tenants because he said that the tenants are a little bit older. So he said we should put in a handicap pole. I said that's fine. So we were going to do that, but the tenants kept refusing it, and they did that again and again and again. My contractor literally went to the door, knocked on it, and the tenants would say, we don't want you to work today because we're tired or for whatever reason. Now, we had all of these things documented in our notes because my property manager does that. I'm not super good at taking these notes. I'm not very well organized in that sense, and I have other things that I need to focus on, so I wouldn't do that myself. But my property manager did that. So now when they filed this lawsuit, all we had to do was show all the notes from the property management company, and they had no claim. Now, this is where a lot of people run into this debate of, why would I want to pay a property manager? Because now that means my profits are going to be smaller. And you're 100% right. Your property manager is going to cost money. However, in exchange for the fee that your property manager charges, you get your time back. So now this is where you have to value and understand, what do you want to be? Do you want to be a property manager, or do you want to be a real estate investor? If you want to be an investor, your time and focus and energy should be spent trying to find more real estate deals instead of trying to just manage the deals that you have. And so for me, I want to be an investor. I don't want to worry about managing deals. I don't want to go through that headache. It's not worth my time, and I'm not an expert in that. Instead, I can hire the experts who take a fee, and now I get my time back, and I can spend my energy, time, and focus on building more real estate deals. So this is where you have to figure out where you want to be, and I would recommend that you focus on building that growth mindset, where instead of just trying to pinch pennies of how much you can make out of this one deal, figure out how you can buy more deals, have a bigger pie, and the only way that you can do that is if you're not the one individually managing every single deal. When I invest my money, there's two things that I always look for. I look at how much risk is involved, and I look at how much money I can potentially make. If I was gonna invest $10,000, and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm going to expect very different returns to justify my investment. Bunty is a risky investment, so I'm going to need bigger potential returns to justify me giving him my cash, because as soon as I give him that $10,000, there's a good chance that he's going to invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm gonna invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? Who's gonna give you the best return for your risk now? Not so easy anymore. There's three different ways that you can take this. Option one is you can spend all the time researching these companies, and you might decide that Apple is the best company to invest in based off of all your research, and now you invest all your money into Apple. This one has the most risk because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside because now if you're right and Amazon wins big, then you're gonna win big. Option two is now you can open up a stock brokerage, and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. If you do want to learn more about how to actually open up a stock brokerage and invest your money in stocks, our team wrote an article on our website, theminoritymindset.com, that walks you through how to do that. So if you want to read that article, I'll link it for you in the description below. This one requires more work because now you're not just managing and monitoring one stock, you got to manage and monitor a whole portfolio of your stocks. Or option three is you can pay a small fee, and then you can invest in a fund like a mutual fund or an index fund or an ETF, and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. Well, all three of these funds give you exposure to the stock market. They work in very different ways, which can affect how much money you make, which is why you want to understand the differences. And that's what I'm going to be going over in this video as soon as you fund that that thumbs up button below. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here. We're going to call this person a money manager, and we're going to draw him a nice mustache. This money manager is who you're trusting. So you're going to give your money to this money manager, and this money manager is going to create this fund. So this person is managing this fund, and when this money manager likes a stock, they're going to buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're going to replace them with Chipotle. So now he's monitoring the stocks and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is going to make this fund more money. The whole point of a mutual fund is to have a really smart money manager with the goal of this money manager being able to beat the general stock market. So you were hoping that by paying this money manager a fee, you were going to be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that. And you also have the benefit of diversity because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets. What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees. And if you invest $100,000, that's $2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees, and you were able to get an average 7% return on your money, over the next 30 years, you're going to end up paying something like $166,000 in fees to your money manager just to invest your money. Now, look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet. And Warren Buffett took that $1 million and he donated it to charity. I'm going to go over how you can get the general returns of the stock market without paying these high fees. But in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like you need at least $500,000 to get into some of these mutual funds versus some of the regular mutual funds that you're just paying 2% on. You could get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard. And Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, the only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're going to have a computer decide. So you create an algorithm. what are the type of companies you want to invest in, you punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund, where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund. And you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go, because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much, because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day, because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title. Also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard Index Fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy 1 share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard Index Fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest, versus the index fund you do. However, the index fund allows you to automatically invest or withdraw your money, versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard, versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, that index fund gives you the benefit, because now your money can automatically be invested every single month without you having to do anything, versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money
money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account, and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do, because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks, and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out, and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, I mean, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go, because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are going to do great. There are some mutual funds that are going to greatly outperform the market, but there's a chance that you might not get that mutual fund. There's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. I mean, do you want to have the automatic reinvestment into an index fund, or do you want to just invest your money into a brokerage that can automatically invest your money for you? Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct. But over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company.
Going aside from the business side, if you're not creating your income, well, then you can also have your assets pay for your income. If you invest your money in the stock market, and you can grow your money in a couple of years and make $100,000 worth of profit, well, this $100,000 worth of profit is going to be taxed way lower than the taxes you would pay if you earned this $100,000 from your job. Why? Because it's a different type of tax. It's a different type of income. Your job